Hi, I'm Sandra Toders from the Faculty of Business in UTS, and this is Accounting for Business Decisions A. Today I'll be explaining how to analyze accounts receivable. First, accounts receivable is money owed to the company by its debtors, so basically it is the money that the company is expecting to collect in return for a sale or a service, and is recorded as an asset on the balance sheet as it will provide future economic benefit. After accounting is being done with recording and reporting accounts receivable and estimating bad debts, they start to analyze accounts receivable to know how well the company manages its receivables. The first step in analyzing accounts receivable is to perform horizontal and vertical analysis, followed by turnover ratio and allowance ratio. Horizontal analysis shows if the institute's receivables balance increased or decreased from the prior year. We subtract prior year balance from the current year balance to get the dollar change in account balance, and then divide it by prior year balance to get the percentage of change. Vertical analysis shows receivables and bad debts as a percentage of assets. It is calculated by dividing the account balance by the total assets. Afterwards, accountants can work on the receivable turnover ratio, which is a comparison of credit sales to receivables that measures a company's ability to generate and collect receivables. So it is equal to credit sales divided by average receivables, where average receivables equals to the sum of beginning and ending receivables divided by 2. It is usually followed by days in receivable ratio, which is 365 days divided by receivable turnover ratio. Days in receivable ratio shows what the company is expecting to collect each day. Companies always want the receivable turnover ratio to be high because it will indicate that the company collects its receivables faster. However, companies do not know the percentage of sales made on credit, which creates an issue with calculating the turnover ratio. That's why accountants calculate allowance ratio. Allowance ratio is a comparison of the allowance account to receivables that are expected to be uncollectible in the future. It is calculated by dividing the allowance for doubtful debts by gross receivables, where gross receivables is the sum of net accounts receivable and allowance for doubtful debts. Generally, companies need the allowance ratio to be as low as possible because it shows what they do not expect to collect. In summary, analyzing accounts receivable is essential because investors, creditors, and managers would want to know how well the company manages its receivables. The first step in the analysis is to do horizontal and vertical analysis. High receivable turnover ratio and low allowance ratio are always preferred. Thank you for listening.